Raising startup funding can be one of the most powerful growth moves when done the right way. The right capital at the right time can unlock faster execution, stronger teams, better products, and global opportunities. In this video, you will learn how to raise startup funding for your new business or startup. Step number 1. Preparing your startup for investors. Investors don't fund ideas. They fund clarity, execution, and momentum. Before approaching any investor, a startup must look fundable on paper and in reality. This preparation phase is where most founders cut corners, and that mistake shows up immediately during pitches. A fundable business starts with a clearly defined problem, a specific customer segment, and a simple explanation of why your solution wins. If this cannot be explained in under 1 minute on a whiteboard, the pitch is already weak. The first step is tightening your business model. Founders should map revenue streams, pricing logic, cost structure, and scalability using basic financial models. Simple tools like cash flow projections, break-even calculators, and runway planners are essential. Investors want to see how money flows through the business, not just future dreams. Even early-stage startups should show 12 to 18 months of projected cash movement with realistic assumptions. Next comes traction proof. This can be revenue, user growth, pilot customers, wait lists, letters of intent, partnerships, or strong usage data. Tools like analytics dashboards, CRM systems, and cohort tracking help convert raw activity into meaningful signals. Investors look for consistency more than spikes. Slow but steady progress beats one-time growth every time. The pitch deck itself must be clean and logical. Standard sections include problem, solution, market size, product, traction, business model, competition, go-to-market strategy, team, financials, and funding ask. Each slide should answer one clear question. Overloaded slides signal confusion. Visual clarity matters because investors scan more than they read. Storytelling is another critical element. Numbers open the door, but narrative keeps attention. Founders should explain why this problem matters now, why existing solutions fail, and why this team is uniquely positioned to win. Real customer stories, data-backed pain points, and clear execution plans build trust. Finally, preparation includes anticipating hard questions. Investors will ask about risks, competition, margins, churn, scalability, and exit possibilities. Practicing answers using mock pitches, feedback tools, and mentor reviews reduces anxiety and improves confidence. A well-prepared startup doesn't chase investors. It attracts serious conversations because everything looks intentional, grounded, and execution-ready. Step number 2. Choosing the right funding path. Once a startup is prepared, the next challenge is choosing the right funding path and structuring deals that do not damage the company's future. This is where many founders make irreversible mistakes. The biggest error is assuming that one funding route fits everyone. In reality, the best funding choice depends on growth speed, capital intensity, risk tolerance, and how much control the founder wants to keep. Bootstrapping works best for businesses with early revenue, predictable costs, and moderate growth expectations. It preserves ownership and forces discipline, but it limits speed. Angel investors are often the next step. The right angels bring more than money. They offer industry insight, early credibility, and introductions. Founders should prioritize angels who have built or funded similar businesses, not just those with capital. Institutional investors come with higher checks and higher expectations. Venture-style funding demands rapid scaling, aggressive targets, and a clear path to large outcomes. Founders must be honest about whether their business model supports this pressure. Taking institutional money without venture scale potential creates long-term stress and misalignment. Negotiation is where knowledge becomes power. Key terms matter as much as valuation. Equity percentage, liquidation preference, board seats, voting rights, pro rata rights, and founder vesting all affect control. Many founders focus only on valuation and ignore these clauses, which later restrict decision-making. Using term sheet breakdown tools and dilution calculators helps founders understand real outcomes, not just headline numbers. Another smart approach is staged funding. Raising smaller rounds tied to milestones reduces dilution and increases leverage in future negotiations. Some startups also use non-dilutive options like grants, credits, partnerships, or revenue-based financing to extend runway without giving up equity. These tools are especially useful during early traction phases. Founder behavior during negotiation also matters. Desperation weakens position. Silence, patience, and clear boundaries signal confidence. Talking to multiple investors simultaneously creates competitive tension and better terms. Founders should always remember that fundraising is a two-way evaluation. The goal is not to close money fast. The goal is to secure aligned capital that supports growth without stealing flexibility. Smart funding choices protect ownership, decision power, and long-term vision while still providing the resources needed to scale responsibly. Step number 3. Funding traps founders miss. Before raising any money, the most important thing a founder must understand is that funding is not just about cash. It is about control, timing, risk, and long-term pressure. Many founders rush into fundraising because they see others doing it, not because their business is truly ready. This is where problems begin. The funding landscape includes bootstrapping, friends and family, angel investors, venture capital, strategic investors, grants, accelerators, crowdfunding, revenue-based financing, and debt instruments. Each option comes with trade-offs that are rarely explained clearly. One common trap is raising money too early. When there is no clear product validation, weak traction, or unclear unit economics, investors demand more equity. Tools like simple traction dashboards, early revenue trackers, and customer validation tools help founders avoid this mistake. Before pitching, founders should clearly understand metrics like customer acquisition cost, lifetime value, gross margin, burn rate, and runway. If you cannot explain these on a whiteboard in simple terms, you are not ready to raise. Another major trap is confusing valuation with success. A high valuation looks good on paper, but increases expectations and pressure. Missed targets can lead to down rounds, loss of credibility, or forced exits. Smart founders use cap table tools to simulate dilution scenarios before accepting money. Understanding how equity splits change across funding rounds protects founders from losing ownership silently. Many founders also underestimate investor alignment. Not all money is good money. Some investors bring experience, networks, and strategic value. Others bring interference, unrealistic growth pressure, or misaligned goals. Researching investor backgrounds, past investments, and exit history is critical. Founder communities, pitch databases, and investor tracking platforms help with this due diligence. Legal and structural mistakes are another hidden danger. Poorly drafted term sheets, unclear shareholder rights, and missing vesting schedules create future disputes. Using standard legal templates, basic startup legal tools, and professional review early can prevent years of conflict later. Finally, fundraising should never replace building a real business. Revenue, customer love, retention, and operational clarity reduce funding risk dramatically. The strongest position to raise money is when you don't desperately need it. Funding should accelerate a working engine, not compensate for a broken one. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.